Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, August 22nd, 2019. Well, the battle at 189 continues. That's the support level, the top of the recent trading range now. We're going on almost about 3 weeks close to it since we've been in that level. There it is, 20 days, 14 bars since we entered the trading zone between 189 and 179.21. So yet another failure. Remember, when you're trading off a daily time frame or using that for your analysis, all that matters is your daily close, or at least that's the important thing at the end of the day. You know, intraday can tell a story if you have a very solid impulsive break, but in other words, you don't that's not a breakout when you have these skinny parts. That's the candlestick shadow, or when it's above the candlestick wick. So we've had several attempts to try to pop 189. All of those rejected so far, so that remains the big level to watch. We had a pretty impulsive reversal. I'll get to some things on the 15-minute or 60-minute chart here in a second. So 189 remains the big level for QQQ, and another day, another failure by the bulls to take it above that level. So SPY 294, that's the level we've been watching. We've been in that once again, same period of time, going on almost 3 weeks now, and just multiple failures. It's just amazing how well these levels have acted as resistance since went down in there. And again, there's other reactions to the left, but multiple failures so far at that 294 level today, including a high of 293.93. And I think on the 60-minute chart, when we fell back here all the way back on August 5th, had it at 293.99. So you know, close enough for government work. We'll call it 294, and that's still the level the bulls need to take out. Now, so what did happen today, and what happened yesterday? I posted on the futures as well as these ETFs, SPY and QQQ, that we had some small, what I call micro divergences. The 60-minute chart, we had divergences there when we ran into 294, and SPY was rejected. We've had divergences here again yesterday when we hit it. And actually today, I'm sorry, we didn't have it yet yesterday. If you recall, we needed to make a higher high in SPY, and that is exactly what we did today. We popped up early in the session, made a run right at that 294 level, and we were smacked down hard. So that's probably the most significant event. Is not only a failure, first and foremost, another failure there, but a pretty impulsive rejection off the failure. Now, so what I said, did a update earlier. Members of the site, you might want to check that video out. I put a video out today showing you some of my favorite sentiment indicators and how to use those, and some considerations to make too in varying market conditions. That's where I think a lot of traders go wrong, blindly following extreme bearish bullets sentiment in all market conditions. So take a look at that. And in that one, I did a brief update on the market, and I'll show you what I covered here. So the big trading range is this. Let me go back to daily chart. It'll look a little easier there, a little more clear. All right, so the big trading range right now between SPY is, again, 294 down to 282, and that's the range we've been in for the past few weeks. But more so in the last 4 days, we have this smaller trading range, so that's a level to watch. And you can see we're either, and this is, I find it quite common when you come across a price channel, and this we're more so a trading range. You can call it a channel, but when you have a security with a price channel, which means it's either tracking up like this, that's an ascending channel and bouncing between those levels, or a regular flat channel or slightly downward or any downward sloping channel, you can often put a midpoint in that channel, is what I've found many times, and that will then act as support and resistance within the larger channel, or in this case, this is a trading range. So if I box it in again and we put a midpoint, notice how we're either most of the time trading for a few days below the midpoint or above it. And then once you crack down below, you stay below, you gapped up. And so far, this is it. We're at the upper point. We have this little compression here. So looking at it that way, obviously, once again, nothing's changed where the bulls want to see us see this top of that level, 294, as well as 189 on QQQ. They want to see those levels get taken out, and obviously the bears don't want to see that happen. And I mentioned there's some downtrend lines above, so not the end of the world. They pop it by 1% or so, but anything much more than 1% above those top of the ranges will take out some pretty significant levels. So at this point, what you're watching for again is a break above, especially the downtrend lines which I showed you on the 60-minute charts, or a breakdown will probably bring us back towards the bottom of the channel. And again, we've been in this trading range for a while, and I still think that once we get down there, we'll probably break through it to the downside if prices are sent back down to the bottom of the channel again. Maybe, maybe not, but these things don't last forever. So those are levels to watch. And again, until and unless we make a definitive and impulsive break above or below, you have to recognize the market for what it is, and that's in that sideways trading range, trying to make its mind up to which way is the next trend it wants to take. And you can see we can do the same thing on QQQ when I box in the range. Give us the midpoint there, the range right around that point. Not as well defined, but somewhat. You can see this similar story to SPY there with these candles either at the top or bottom. And there's our near-term trend for the last few days. A lot of tight price compression. So those are your levels to watch. And I'll take a look at the futures real quick. We'll start out here with NQ, the NASDAQ 100 futures, because I think it's mostly, I won't say all, but mostly about tech. I like to keep an eye on those two indexes, the ES and NQ, or in other words, the NASDAQ 100 and the S&P 500. Charts are quirking out here. Give me a second. Okay, there we go. There's my lines. All right, so in yesterday's video, what I had, or yesterday's update, I should say, on the market, the updates that I posted, I was watching this downtrend line right here, and that's what NQ had come to. We're rejected there. It came in right around that 77.50 level. We had a little pop above it. We took out the downtrend line, back tested all night. So this morning I did an update on rightsideofthechart.com. We were still back testing at the same time. ES, which I'll get to in a second, the S&P 500 futures, were at a comparable downtrend line. A member on the site pointed out they had this trend line draw this way, so I said, you know what, it's certainly a legitimate trend line. Right here, if you look at the recent highs in the markets, both on the NASDAQ 100 and the S&P 500, we had this little quirky candle right here where that was the Fed. That was what I call post FOMC noise, the knee-jerk reaction from the FOMC meeting. And so you had just everything gets one-sided trades. Machines are gunning it up, and then they turn around and reverse it. So the point is, you can take a couple liberties there on that trend line, which I did here. So I think they're both valid is what I'm trying to say. And this is the one the member had pointed out, and they both come in just as well. So you can look at it one of two ways. You can look at it as a breakout, a back test, which then failed today. But now we've sliced through this line a couple times. And either way, recent highs are always important. So I think this is the trend line to watch right now. Either way, we have a rejection there or a failure on the other one. So now we didn't go down so much. You can't, bears can't start high-fiving each other yet. There's work to be done, and that's again to take out this 76.51-ish level, call it 76.50, that previous reaction low. Yeah, it's that, and those are levels. So, we pretty much came right around those previous reaction highs. And just like QQQ and SPY, we had negative divergence recently put in place on here on NQ as well as ES. So we had the divergent high. So far, we've had a bout of impulsive selling off there, which is also an impulsive rejection off the top. And that's just the common theme, that maybe the bulls will take it out and run. So far, they've been rejected on every attempt to take the NASDAQ and the S&P 500 above those recent trading ranges, and so this is still my preferred scenario. After that little rejection there today, I have to say my barometer is what's similar to a barometer. Barometer measures atmospheric pressure, and my barometer is just telling me that, hey, that was a pretty impulsive smackdown today. Work to be done, but I'm starting to become a little less convinced that the bulls might be able to pop this and run. But again, if they do, like I said, it's we have some pretty good resistance here at about 78.18 or so, 1% or so. Well, maybe not from where we are right now, but from where we were yesterday. So not a lot of upside, much more than that. then that I have to say you got to give it to the bulls if they can power on through there and hold above that level. So as of now, I'm still looking for the downside, still positioned and leaning that way. Let's look at ES and we'll wrap this video up. ES, the S&P 500 E-mini futures, same story. You have the downtrend line there, and it's pretty clear on this one. Even with the Fed-induced pop right there from the FOMC announcement, it comes in perfect. So you have a lot of reactions on it, and then multiple attempts here. So far a failure, but not a big rejection. To help tick up my barometer a little bit more. Of course, I said you need to take out these recent lows, 28.94-ish. Take that out with conviction. Also come down below the midpoint. When you look at the futures here, you can see the midpoint of the recent trading range. If I could draw a line right here. So we've spent either a lot of time above or below that level, and yep, that's what we need to do. So we'll watch these levels. If it goes the other way, there is the potential to push a little higher, like I told you yesterday, and still keep these divergences intact. So I could sit here and talk about it all day long. Let's see who wins this battle. It's definitely a battle. Anybody that's been trading now, I think that's clear to all that that's an important level. So let's see how it's resolved. One thing I'll add before we wrap it up, I think it's worth jumping out to the longer term time frames, because what this does when you have a sideways trading range. Even right now it's only been a couple weeks, going on almost 3 weeks. But what that tends to do, or what it does do, when you're in an uptrend, a bull market, or an uptrend like we have been in, going sideways will bring your momentum indicators down, because and I'm talking about the PPO and the RSI, some of my favorites that I like to use. These are momentum indicators, and when the prices are going up, the momentum indicators are going up. So if you go sideways during an uptrend, if the market starts going sideways, that means the momentum has stopped. It has stalled. You're not going up anymore. Just like if you're in a strong downtrend and all of a sudden you start to base. That's usually how a lot of bottoms happen. Sometimes you get a V bottom, or sometimes you'll base on a security or an index. And so by going sideways, it then starts to turn those momentum indicators up. So all I'm trying to say here is that the bearish crossovers on the PPO and the RSI turning down, and the negative divergences that were in place at the recent highs are still very much in place. And so trading sideways, look, it's not the end of the world. We could go up, but some of my longer term indicators can flip to bullish soon, and will soon. This is QQQ. This is my monthly chart. This goes back. These are monthly candlesticks. Here's your entire bull market. Clear as day to me right there. All these reactions, all the way from back in late 2018, unlike every other index at bottom in 2019. But you also have the 2019, March 2019 reaction low, and just lots of candles on there, bodies and or shadows. And we're sitting right there precarious. This is a market that's lost momentum. Usually you hit the trend line and you bounce, you hit it and you have some good bounces. We're losing momentum, which is reflected in the negative divergence. And then one of my favorite long-term indicators is rate of change 12. Sometimes I'll flip it to a rate of change 13, depending on the index or the security that I'm looking at. But rate of change 12 does a pretty good job for spying QQQ, defining bull and bear markets. I've covered this one in the past usually when I go into long-term analysis. There was the dot-com bubble and the bear market that followed. It told you most of the time you're in a bear market. This was the Great Recession, the 55% drop. Doesn't look like much there. There it is. Couple whipsaws. Nothing's perfect, although this was, a near bear market in the NASDAQ 100, and you fired a couple times there on those monthlies. So look at this. We're right now very small bar. We're only we have about another 8 days left in the month, and if we broke down, we'd have a couple things would happen. Number one, if we drop much over the next month, well, actually this is the candle right now. We're working on this as our monthly candle, and get a monthly close. That in itself would be a sell signal. Take out that 20-month EMA right there. that blue line, which does a great job of defining bull and bear markets. That would also be another powerful, and I'm talking a long-term bear market sell signal. This one right here, whipsaw, but we closed almost on it, right about on it, and this one we regained it the next month. So you want to see a big red candle, like I say, the redder the better, and then a follow-up red candle. That would most likely put the nail in the coffin and say, welcome to the new bear market. That's my take. And then where I was going with that is even this sideways trading, what it does, it tends to roll these momentum indicators down because again, the upside momentum is gone. When you move sideways, you no longer have upside momentum. You just have, well, no momentum really. And so there it is. Same thing on SPY, and you can see SPY is just there. Look at the size of that histogram bar right there on the ROC 12. SPY already broke down. That's why I maintain. And technically speaking, this won't go down in history as the bull market top because we made a very slight marginal new high. But for all intents and purposes, it looks that way to me. We broke down. There was a primary bull market trend line. We broke down with an impulsive candle, and we've simply been back testing on the S&P 500. If you can put a big red candle in, get back below that 20-month EMA right there, the blue dotted line. Clearly put it in the rearview mirror. Meaning bring prices down below it, and then flip the histogram right here down to red. And all that matters here, guys, is a monthly close. Anything that happens between today and 4 p.m. on August 30th doesn't matter. It's how you close a month. And if you get a red one, better if you see a couple more. This was a whipsaw signal, as I said so far. But if you look at it this way, let's say you were trend trading. Let's say you pulled everything out of your 401k because you had that signal. So far, you haven't lost. You're right back to about where the market peaked back then in late 2018. That's where we closed today. You see the crosshairs coming right back to the 2018 highs. So again, this market hasn't gone anywhere. It made a new high on paper, but it's really had a big drop between, and it's right back to where it was back in late last year. And that's it. We'll wrap it up here. And again, let's just watch those levels on QQQ 189 and SPY 294. And if we start to move away from those to the downside, then watch the midpoint of the channels, and then most importantly, the recent lows. And then anything under that. And I think even if we start to approach those lows again anytime soon, I think selling will just accelerate. I don't think we'll walk our way down there like we walked our way up. I think it'll be a much quicker slide right through there. But that's just my guess, And like I always say, support is support unless broken. So that's the support is the recent lows on SPY and QQQ, or the next big support level, if you will. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.